small cap index, which will come up on as well. And there is about a 0.25% cut on the Nifty small cap index. Market breadth for now is positive, but this is just, the initial first minute or so that we have. So it's a slightly subdued kind of start. But, well, we all know what happened yesterday, right? I'm not saying, well, the same thing happens, but yesterday also till about 150, things were very subdued and then things took off like a rocket. But, as we go into today's session, remember, we got a 3-day holiday in front of us. That Nifty heat map, more down than up. You got about 13, 14 names which are higher, everything else starting lower. Surabhi.
Okay, so on the lower side, of course, is IT. No surprises there. Wipro's down 5%. HCL Tech 2%. Infosys ahead of numbers, 1.6% lower. TCS is selling off about 1.5%. Tech Mahindra, all those stocks are down. The other problem for the market is that consumer stocks aren't really finding much mojo this morning. Asian Paints, Nestle, Titan, most of them are on the lower side of the screen. Then come your heavyweights. L&T is not really contributing much. In fact, it's down 1.2%. Reliance, 0.5% lower. ITC is down about 0.3%. Lever, like I said, along with the rest of the FMCG pack, also weak. The only part that's working for the market are financials. ICICI Bank, 1.4%. HDFC Bank, 0.4%. And that's about it. Even financials, very, very selective for the time being. There's some buying on pharma this morning, which is interesting. Dr. Reddy's is up and about. Apollo Hospital, Sun Pharma, Cipla. Pharma is doing okay, and top financials are doing fine. Shriram Finance also about 0.7% on the higher side. So it's pharma and banks, to the rescue, but IT is in a trouble spot.
Well, that's right. Surabhi, a couple of stocks, though, that are in focus. Angel One, the stock is down closer on 4.5% because of those weak numbers. On the flip side, you have the Vare Group companies. I think Vare Renewables came out with its set of numbers, and that stock is higher. Vare Energies as well is one of the top movers on the upside in today's trading session. So both those two should come up for you. Big green is what we're seeing on both those two stocks. The other banking name that's doing well is Ujjivan Small Finance Bank. Well, that's up by closer on 5%. It's moving on very, very large volumes. I think you should get that one up for you on the screen. IDFC First Bank is now at the low point of the day. I'll tell you what, in the last 1 month, the Nifty Bank is up closer on 9-10% or thereabouts. It's done well. But IDFC First Bank was up 15%. So it appears there is some profit taking that's coming on this counter. And that explains why that stock, in fact, is actually down closer on 3%. It's seeing some kind of profit taking post the recent big run that we saw. Tanla, well, that was one as well, had some positive news flow. So that stock, in fact, has opened up with some green on the screen. JTL, well, yesterday the stock got slammed back because some reports indicated that there was an ED raid. But for the time being, the stock has pulled back closer around 5% or thereabouts. You need to understand whether or not it's on the investor with regard to that betting scam, or was it on the company? So I think the street is still waiting for a response on the management. For the time being, the stock is up closer on 5% after getting slammed 18% in yesterday's trade. Vare Energies, though, that's the stock of the morning, up 6% as we speak.
Yeah, no, absolutely. 23.66 on Vare, and that is a big mover. And by the way, Vare is now the number 2 biggest volume-led gainer on the NSE. Number 1 is Mazgaon Dock. Mazgaon is up 3%, but outsized volumes on Mazgaon for this point in the day. Just about starting 500,000 shares already on Mazgaon. And, there is Vare Energy and Vare in the other Vare company as well, which is up 12%, 1151 that's the one, renewable.
That's the one that came out with its numbers.
Yeah, that's the 12, which is up 12.5%
Yes.
right now. So big one, and both have got tremendous volumes at this point. K Fintech is up 3%, 1,084 on K Fintech. Again, very large volumes. Garden Reach 2% higher. Again, one more shipbuilder, along with Mazgaon, which is showing up with gains. You got Amber, which is up about 2%. KEI Industries is up about 2.5%. Cochin Shipyard. So you got all 3 shipbuilders now, which are up strongly. Yesterday, you had some moves in these hospital names. On the downside, I can spot Narayana on the upside today, 1.5% on this one. We were talking about the Vare sort of twins, but also look at Weber Solar, which is up 5%. Premier Energy, again, in that space, 2.5%. So, yeah, there are shipbuilders, there are these solar names, both which are kind of sort of moving up as a pack. Wipro is now, by the way, the biggest volume-led loser. It's down 5.5%. Stocks at about 234. It's followed with Infi, the preview for which we just put out with Rima 5 minutes back. Numbers after market hours. And I think certainly with what Wipro has done, expectations from the consensus expectations, etc. The general hope from it would perhaps be a little lower. Angel, of course, we highlighted numbers, 4% lower. IDFC First Bank is down 2%, 62, and has got tremendous volumes in it as well. TCS is down 1.5%. Sonata Software, LT, I think IT on the downside is emerging as the sector. So maybe the IT index will come up. Yeah, 2% lower on the Nifty IT index after yesterday's near 1% cut. So 32,591 on the Nifty IT index. Tahir Badshah is with us. Tahir, I interrupted you there. You were talking about, of course, the global uncertainty and the wait and watch, but the local drivers here. I mean, rates is one, right, on the downside?
Yeah, I think rates obviously will be headed lower. Earlier, the expectations were for probably about 50 to 75. We are probably now looking at more like 75 to 100 over the course of the next 9 months or so. So I think that part is quite certain. We have some of the other drivers as well in the sense that, liquidity is up, regulations are somewhat loosening, government policy and actions are probably a little more vibrant compared to what they were in the prior 2 quarters. So I think there is obviously the one straw that we can probably hold on to at this stage is the fact that we can probably see improved domestic growth. However, upcoming quarterly results, etc., will probably not reflect that. It will therefore require a certain amount of patience from investors to see some of these, actions which have been taken to translate into growth over the next couple of quarters or so. So I think that's basically the name of the game at this stage.
Tahir, hi, great to have you on the show this morning. So the question is what you said, that the market might not skyrocket from here, but it will continue to bounce around. Earlier, every time there was a dip, there was a template. You just had to go by and back the same leaders, the same PSUs, the same capex stocks, the same EMS companies. Has that template broken, or has it been challenged? And what are you doing with the earlier leaders, the old favorites now?
So I think at least some of those that you called out are still relatively more domestic oriented and probably even from a tariff perspective on the right side of things. So I would like to believe that they will still remain the go-to kind of areas. And even for us, I mean, beyond a particular point, if we have to identify places in the market which can grow ahead of system rate of growth, I think only some of these, whether it be industrial, some parts of consumer discretionary, parts of real estate, etc., are the ones which we can probably go to at this stage. So I think that continues even at our end. There have been a couple of other parts which have joined the fray, I would say, in some manner. Let's say value consumption at one level seems to be making some sort of a comeback, and rightfully so after a long cyclical downturn. And I think we have seen some initial reports on the monsoon, etc., which probably are also promising. So let's see how that pans out. These are all things which are up to see as to what how they turn out to be. But I think these are the areas where probably there is some value. I think pharma too is another area. Combination of some domestic pharma as well as some of those which are probably going to be somewhat better placed, even with a tariff scenario coming into play. So pharma healthcare is another area where we can probably, bank on somewhat better earnings outcomes compared to a few of the other pockets of the market.
Okay, all right, that gives us some ideas. By the way, just want to draw attention to the market once again, because now things have taken a bit of a deeper knock. It's a 120-point fall now on the Nifty. And the problem for the market is that barring one or two of your large cap financials, banks or non-banks, nothing else really seems to be working today. There's a little bit of pharma, but then the tech fall is really deep. Wipro is down now 6%. It's taken the whole sector down with it. FMCG is not working, and even stocks like L&T, Reliance, the other big boys, not able to help the bulls case, at least not right now.
Well, that's right. There's only so much that the Nifty Bank can do. The Nifty IT index is under the weather. The Nasdaq was under pressure overnight. You had those numbers from Wipro. And there is a bleak expectation coming in for Infosys. So all those three factors, they are weighing on the IT index, though the Nifty Bank is still holding with some mild green out there. And if we need to fight back today, the Nifty Bank will need to lead the way. Tahir, good morning. Good to see you in. What's your take on these IT names? One argument is that, in fact, valuation-wise, they're pretty okay. They've come to the long-term averages. The problem is there's so much of uncertainty. Guidance cuts, weak numbers. And, you don't know what Mr. Trump is going to do next. What's your approach to these names?
I couldn't agree more, Nigel. And, I have also been kind of latching on to this view that tech will probably be, some extent a reasonably good defensive and probably help us ride a little bit of the domestic volatility. But of course, after these developments, this is the most headwinded sector that we can probably think of at this stage. Both in areas of growth, obviously, we are probably going to find it difficult from everything from whether it is tariffs, slowdown in the US, what happens to Doge, and consumer spending and consumer discretionary as far as the US is concerned. So I think there is a fair bit of challenges which are around. And I think at this stage, the only argument that probably is be made to work for the IT companies is their valuations, and not necessarily as much in terms of price to earnings multiples, but probably if you look at them from a free cash flow yield or an earnings yield perspective, or an cash flow yield perspective. So I think that is the only thing that you can probably latch on to at this stage. But then that clearly means that these now have turned into, they can only be seen as from the lens of value, and then you have to be a patient investor in order to probably get your returns over a period of time. So this, to my mind, is a sector where today, in my mind, is also a debate of whether we should even be a neutral, we should even be holding a neutral weight as far as the sector is concerned. But that's where we are.
The cash flow yield, you said, Tahir, was what, around 5-6%?
I'm sorry, what is that?
What is the cash flow yield for these companies right now?
So we are at the lower end of the band, more in the vicinity of 4.5, which is not bad. But that is the only hook that you can probably, as of now, latch on to. But obviously, both news flow wise, numbers wise, we're seeing that in some of the results which have come by, it's not going to be an easy ride. And it all, then we also have the obvious overhang of what happens to AI, at least in the short run, if not in the long run.
Okay, so that's IT, and it's clearly under the weather, like Nigel said. Pharma, something that you said perhaps offers a little more opportunity. Just expand on that point, Tahir, because I mean, a lot of these companies also have significant US exposure. We don't know if they'll be off the hook or not. There's still some uncertainty there.
Yeah, so at least some parts of the pharma system, pharma sector, which probably is not necessarily only generic based, even if it is exposed to the US, is probably going to be able to weather it better. So upcoming spaces for mid-sized companies, CDMO, CRDMO, that is the part which probably will hold up a lot better, because that is something which at least where there are companies which are relatively better positioned and probably can, are in a position to demonstrate growth which is in the vicinities of the 20s over the next 2-3 years. So I think that space holds, to my mind, a relatively better, attractiveness. And I think then we can always, we also have the option of supplementing that with some of the domestic pharma stories, plus some of the healthcare options also that we have. So that at least makes us a good combined, parcel, which probably can occupy some decent overweight in the portfolios.
Tahir, just one point as we are winding up. I mean, this point on earnings and narratives shift with stock prices. I've always seen that in my stock market reporting career. When we started the year and Q1, Q2 were bad, we said, oh, it's because of elections and government is not spending. Second half is going to be very strong. It'll be a big recovery. Then we came to Q3. Q3 was a complete washout, 5%, 6% earnings growth. Now we're at Q4. I mean, do you see more downgrades ahead? What is your assessment, expectation from Q4? And more importantly, as we step into the new year, what lies ahead in terms of corporate earnings growth?
So if I were to go back, my memory serves me right, I think we saw the worst, from a market standpoint and from a shock and awe perspective, was more like the September quarter, the second quarter of this fiscal, which was clearly subpar, significantly subpar, and well below, early single digits. And that's something which probably was the biggest shocker. But I think after that, the expectations then have obviously moved down. There have been earnings cuts along the way. And now I think the market expectations are relatively more, I would like to think, at least for the near term, over the next 1 or 2 quarters, relatively more subdued. Having said that, I don't think the March quarter results also will probably be able to significantly surprise. I only am hopeful that the pace of earnings downgrades from here on probably will abate compared to the last 2-3 quarters. We are somewhat away from an upturn in that cycle, in the sense that we'll probably take some time before we get into an upgrade cycle. But I think the market will take comfort if there are no further downgrades. And that is what probably March quarter seems to be looking like. Look, like as I said, I mean, we are even while some of those domestic drivers are clearly starting to shape up, but by the time they reflect into numbers, will be a few quarters from now.
It'll be a few quarters from now, but maybe, I mean, Q4 will be weak. I don't think, I mean, overall, I don't think one should, too many expectations. But of course, the market's not pricing in what Q4 is going to be. It's trying to gauge what, where things will be 3, 6, 1 year down the line. And there, as Tahir says, maybe things are looking a little better. Maybe, just to take a quick look at what's happening around in the market, broader markets, apart from what we've already mentioned. IT, of course, I mean, the index is down 2, that's a big one. Hero MotoCorp is down 3%, 36.77 on Hero. So that's coming up with a large cut. And what else? I mean, Tata Elxsi and JSW Steel, Titan, Coal India, these are all down between 2-3%. There's Naukri, that is InfoEdge, which is down about 3%, but that's again like an IT name. Chola Finance is down about 3%. AG's Logistics, but it means sharp move up in the last 2 days. That is coming under some amount of pressure as well. Godrej Consumer Products is down about 1.5%. So that's the overall picture. 100 points lower on the Nifty is what
Prashant,
you have.
we have our guest with us.
Yeah.
The man of the moment, V. Vaidyanathan, the managing director of IDFC First Bank, has joined us. Mr. Vaidyanathan, many congratulations. I believe you've got 2 big marquee investors picking up stakes in IDFC. Can you just first take us through the numbers? What does it mean in terms of capital coming in? What does it take your capital adequacy to?
First of all, thank you very much, Lata. Yes, it's a really, really big deal and a very, very important day for the bank because we get 7,500 crores of equity capital. And it's coming in the name of Platinum Invicta, Currency, which is an affiliate of Warburg Pincus. They're getting 4,900 crores approximately. And Platinum Invictus, which is a subsidiary of ADIA Private Equity Division. But ADIA is a really big name, the private equity division. So both are iconic.
No, both are big names.
Big name, like iconic. And, we have worked with Warburg Pincus for like 12 years now. They're really like wonderful, wonderful people. I'm really...
Actually, that was going to be my question to you. I remember it was in March 2024 that they sold off their stake at a very high gain. But what made them come back in just 1 year and 1 week? They've come back to you. What was their thinking? Did they tell you?
Honest answer is I chased them.
Okay.
I chased them because I think the bank needed capital. So I messaged them, I reached them directly. I told them, please, I'll be really happy if you came in. And of course, when we pitched the story, we told them how the bank is set for a phase 2 of growth, how we can create really phenomenal value in the next maybe 5, 6, 7 years. And they are long-term investors. They can see that they made a lot of money last time. Okay. So they felt excited to come again.
Yeah, it looks like they made some 8 or 9x, if I remember right, in terms of where they came and when they exited. But Mr. Vaidyanathan, you see, you needed the capital you don't really need. At the moment, you have a surfeit of capital with this 7,500 coming in, right? What is your capital adequacy now and what was it before?
Like 16.4 or 5 right now, and it'll go to 18 point, close to like 19% after this raise. The thing is, Lata, that, as the CEO, I have 2 very big responsibilities to run a super safe bank. Super safe bank. Super safe bank is how diversified deposits are, etc., and how quality of loan book is good. All that is super safe. But capital is a very, very important part. I take that as a responsibility. And even though we were 16 plus, I have to be honest, I wanted to raise more capital. And capital positions us for growth because you see, one of the key things is profitability. Yes. So the next phase of growth will give us operating leverage, will give us profitability. So I'm really keen about that.
Okay, but it would also mean immediately dilutive of several ratios, right? I mean, at the moment, the stock is showing a red tick probably because of that. Of course, the market itself is in the red. And your share, I think, ran up a decent amount in the last 1 month, about 15% or something. You saw a good gain. So maybe a bit of sell-on news is also coming in. But it will be dilutive immediately when you have, 18, 19% capital adequacy.
Yes, this will have a dilution of 15%. But really, Lata, I want to just share one thing to you and to all investors hearing this program, that the main thing is that the bank has a phenomenal model. Otherwise, our operating profit could not have grown from 750 crores to 6,000 crores in 6 years. It's not possible. So we have a really good model. But my one big learning of life, one day I saw an interview of Jeff Bezos, about Amazon. He talked about, he said, I have a wonderful product, wonderful molecule, but without capital, there'll be no Amazon. It's like that. Today, we have a phenomenal product. People are not seeing the full power of it yet because of, liabilities, laws, and credit card laws, etc. If you take that aside, bank is very powerful, economics, but capital. So if you have capital, this can grow for a long, long time. I really believe that the next phase of growth is transformative for the bank. Bank will be very profitable in the future, and I think you will watch it happen.
Okay. No, I mean, if capital was important for Amazon, it is much more so for a bank. I take your point on that. But how much can you share now? I know you're in a pre-result silent period otherwise, but can you share what do you want to use this money for? Is it earmarked for branch openings? What is it for?
It's the growth. There are two things, actually. I'll keep it very simple for you. If you see the loan book of the growth of the bank, just the retail component of it, retail, MSME, agri, that SME kind of stuff, that was 100 crores in 2010. Today it is 2 lakh crores. So it should give you no surprise to guess what this will be, let me say, 5 years from now. It should go one way up. I'm very clear about that. So that growth, let me call it like at least 20% CAGR for 4 or 5 years, at least that much my eyes can see. So for that is one thing to look forward to in the longer sense. And number two, utilization. So basic answer is growth. Let me tell you, the bank has for 5 years not posted a loss. No intention of posting loss in any quarter, any year, any time now. I can tell you that much. So it's all growth. But second important reason is that there are some businesses which are also, at a stage where it needs scale up for profitability. And there are 2 such businesses.
Okay. You have a lot of sovereign funds. I mean, if I remember right, you had GIC also as one of your shareholders, and now there's ADIA. Can you tell us about the kind of shareholders you have? And also, what does your foreign holding now go to? When you announced your numbers after March, it was, I think, 25%. What does the foreign ownership now go to?
Okay, I don't have the number offhand of foreign ownership, but I can comment on this. The PE private equity side of RDA, which have invested in the Platinum Invictus entity. Now, whom we are allocating this stock. Now, them as well as, like I said, Warburg Pincus, they're really a phenomenal global name. So what this does is actually gives 2 things to us. Let me just tell you that, Lata, these people are really high quality investors. They see everything. They invest only in companies with really good governance. When you can't raise a question on the governance, they are very long-term focused and very, very professional. I've dealt with them for a long time, like super professional. So what happens is that when you get that kind of capital, then we are at total peace of mind. I can focus on the work. I can focus on building a good bank. And then value will get created.
Yes. Okay.
I want to just add one thing that, in my opinion, broadly speaking, to create long-term value, you really will need a product which customers love. It's really important. And, a brand which attracts. IDFC First Bank has become one such brand. It attracts today. And, products are really superior and strong unit economics.
Okay. A final question to you. When Warburg first came in, I think 2012 in Capital First, and by the time they exited, they made, as you said, 9x. What have you promised them now?
I promised them lots of things. I told them they'll make lots of money. Okay. So, and I really believe it can be, because let me tell you, Lata, that the first 5 years, a lot of people sometimes say that, look why they are, your OPEX is high or your cost income ratio is high. It is high. I don't deny it is high because of the liability franchise, credit card franchise. But I tell them that phase 1 was setting up the bank. Phase 2 is operating leverage. Phase 2 is profits. Phase 2 is return on equity. And I have indeed suggested to them, let me say, nobody can promise anything, but I have definitely, like in my own way, told them with a lot of confidence that they will make lots of money.
You said 20% CAGR. So should we say you double the bank in 4 years?
Definitely, I think so.
Okay.
I mean,
All right.
think of 20% and I believe that our profit after tax will outpace this growth. This is my belief. I mean, our numbers are looking like that. This year, by the way, has been a bad year for us because of the microfinance impact on us, and I take responsibility for that. I'm the leader. So think of this year like we had a massive turnaround in our PAT from the bank. We took it off from the loss position to profit. It was supposed to go up. It came down. It happened to us. But we believe from 26 onward for the next 4-5 years, you should expect good numbers on this bank.
Okay. Thank you very much, Mr. Vaidyanathan, for speaking to us. We will look forward to more searching questions and answers after you announce your numbers, your Q4 numbers. Many congratulations yet again for getting some marquee investors in.
Thank you.
Okay. So there you have Vaidyanathan now coming with the more granular details in terms of their capital adequacy now going to over 18%. Of course, it will be immediately dilutive and maybe that little bit of red is seen on the stock. But, you know, capital is big raw material for banks. So, you know, you would grab it with both hands when it comes.
Well, and this is an additional factor, you know, for the banking stocks itself, because you have a big name coming in there. They're showing you $1 billion or thereabouts. So it's a positive rub-off as well, besides valuations and the likes. And besides what it's doing to that particular bank, which in this case, it's IDFC First Bank. But someone writing $1 billion check is showing the kind of confidence, which is good.
Absolutely. At a time when things are otherwise wobbly,
Yeah.
to detect and say this is a domestic-facing industry in a country which is showing like steady 6 to 7% growth, I think, clearly it's a morale booster for the sector as well.
Okay, all right, absolutely. Thanks for that, Lata. IDFC First Bank making headlines, and the clear takeaways: you're getting 7,500 crores in equity capital, 15% dilution, but the capital adequacy ratio goes up to almost 19%, as Mr. Vaidyanathan mentioned. Well, let's stick with banking, actually. There's so much of news flow. Right now, we're discussing, of course, the details and the fundraise at IDFC First Bank. And yesterday, it was actually IndusInd Bank which was hitting the headlines. The company now has declared that the external audit has found the 1,979 crore rupees discrepancy in its derivative portfolio, which is, of course, a little less than what was earlier estimated. Sources have also been telling us that the bank could perhaps see 3 senior-level exits as this matter is finally put to rest. So, I mean, where does this leave investors when we are talking about, some of these, I shouldn't call them really corporate governance issues, but let's say niggling worries that have emerged. I mean, IndusInd Bank being one of the examples. Hetal Dalal, President and COO of Institutional Investor Advisory Services, is with us. Hetal, thank you very much for joining in. So, just to sort of go over the IndusInd Bank example, what does it tell us? Where does it leave us? This derivative discrepancy came out of nowhere. The bank chose not to immediately disclose it, which is why the stock nosedived when they finally did tell the exchanges. And I believe that happened after some RBI nudging. And that is where the issue of investor confidence came about. Now the external audit has happened. Financially, there's not much impact, but it does leave a strange taste in the mouth, doesn't it, when it comes to investors and just clear disclosure?
Very true. Good morning, everyone. I think the fact that this came as a surprise, it was a delayed sort of announcement given from when they figured it out to when they actually announced it to shareholders. It does leave open questions as far as investors are concerned. I think one of the things we keep telling companies, in terms of trying to build trust with investors, is to be consistent communication. Bad news should be delivered faster than good news. And you need to keep investors in the loop when some of these things are happening. You're coming down 9 months after, almost at the close of the year, and then saying that all of this was, we found these discrepancies, indeed will leave investors open to thinking about whether there are more issues or not. I mean, at this stage, this issue seems to have been sort of capped. The numbers are out and the loss will be taken in the financial statements. But I think going forward, there needs to be a greater sensibility around communication and being consistent in its approach as far as investors are concerned.
No, I mean, obviously, IndusInd Bank went through a serious amount of price damage, Hetal. Do you think the worst is behind? And, how should investors look at it? Because on one hand, I mean, the analysts will argue about good value. It's a great asset, perhaps good business. But then all this and perhaps impending management changes. We need to know what's the succession plan, what happens after Mr. Sumant Katpalia. Our reporters are telling us that there could be some other heads rolling as well. So from that standpoint, what should investors be doing?
Yeah, look, I think the CEO succession and the fact that Mr. Katpalia is on his way out was news that came out earlier. So everybody knows he had a 1 year, 10 years. I mean, he has a short window in terms of succession. I think this is clearly something this entire episode of the derivative book would have worked RBI for sure. And there will be heads that will roll most likely. I think what we're going to expect going forward, in our view, is that while this issue seems to be curtailed, and I don't expect there to be significantly no news, when you do see a new leadership, typically what you see is a little bit of a cleanup of the balance sheet. The new leadership will always want to start on a clean slate. It's called the big bath. I don't in banks though they tend to be well governed and they seem to be, and there are significant sort of checks and balances. Some of these things keep cropping up. I don't disagree, but the quantum and the impact is not as high as you would see as we've seen otherwise in in other companies which are not regulated by or are not in the financial services. So I think by and large this issue I would say is put to rest more or less. Will we see more issues? When the leadership changes, you're likely to see some, but we don't expect it to be significantly material. That's what I would look at.
All right. Okay, Hetal, thank you very much for joining in and giving us some perspective and clarity on this development. And hopefully we won't see too many of these because they end up creating a fair amount of uncertainty for shareholders. Thank you for joining in. We'll take a quick break on that note, come back on the other side, and we'll have Ben Powell of BlackRock Investment Institute joining in on Trump tariffs and the global uncertainty.
Welcome back. Well, the good news is the markets have recovered all of the losses. We're almost moved into the green. And as we said earlier, if the Nifty needs to move higher, the Nifty Bank will have to do bulk of the heavy lifting because the IT index is under the weather today. And as we speak, the Nifty Bank is now up close to around 400 points, building onto its gains. And it's only approximately 2% away from an all-time high. So good going on the Nifty Bank. Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute, joins us on the show. Hi, Ben. Good morning and good to see you, Ben. Well, what are you making of the news flow? There's hope that there's going to be some kind of rationality that will come about. President Trump, as well as the Japanese, are having a discussion. A lot of comments coming in from the Chinese as well. And then you have news that various parts of America are looking at suing President Trump because of these tariffs. So a lot of news flow. Do you think things will get better from here on? Rationality will come about and the world moves forward?
Good morning. I think rationality is a high bar. I think we live in an emotional era. President Trump has talked extensively about how he feels for many years or decades America has been exploited by the rest of the world. And now, to some degree, it's payback time. So I think there's more to life than pure rationality, and politics inherently is somewhat emotional. So that's normal, and that's going to continue. That does confuse our lives in markets where we are, kind of always looking for a pure, clean, quantitative answer. It's going to be messier than that. We did think at BlackRock last week was very important specifically where it seems that there are some constraints on the US administration. So they were, I think, a little bit worried by, in particular, the move higher in US Treasury yields. That, I think, was disconcerting to them. And since then, we've seen them adopt somewhat more of a positive approach bilaterally, as you're saying, including with big countries like Japan, India to come soon, we all hope. So I think there are things to be more positive about. There is a constraint, which is good to know, but I don't think we're going to have a purely reasonable kind of market or economic backdrop, because it's a time for kind of passion, and I think that's going to continue.
Oh, absolutely. I mean, we're still watching for all of those headlines and those social media posts, right, Ben? This morning he says that it's been, I think, a great meeting with the Japanese delegation. So let's see what the eventual outcomes will be like. But from a market perspective, first basic question, is the worst of the price damage over? Has a floor been put in place around global markets, equities?
So we're overweight the US, and the US obviously is the huge bulk of global equities. So if you don't mind, I'll speak to the US as an answer to your question.
Yes.
Yeah, look, we think there is something, as I mentioned last week, was like very important. That Trump, who has signaled, I think, that he's much more interested in Main Street than in Wall Street. Yeah, that was very worrying for equity markets. But he is constrained, it would appear, by the bond market. So I think that was like really important information that we got. That's the first thing. The second thing is there's still a lot to be positive about at this time, including the AI megaforce, some earnings growth stories that we favor. So, you know, again, a lot to worry about, many things that are for sure kind of uncertain, but we shouldn't throw the baby out with the bathwater. There are still significant tailwinds that are out there, and we need to remind ourselves of that before we all become a little bit too emotional ourselves, I guess, and too kind of worried about the bad things, of which there are many, but there are some good things as well. So in conclusion, we actually, we're overweight US equities. We think valuation is sufficiently cheap now that we can start to carefully pick our spots as to where we want to be more positive. And again, AI continues to be a very powerful tell force, we think, and clearly America and other markets, but in particular America, is a way to play that.
All right, so Ben, you're saying that you'll stick to the US markets. You know, what commentary we've been hearing over the recent past is the dollar index got a little bit more weaker. Trump still has the problem with regard to deficit, so something's got to give out there. So we could see some money flowing to emerging markets. But you're saying that you still believe that the US market will outperform even from here on. Is that correct?
We're overweight the US, that's true. But I think implicit in your question, Nigel, is something super important, which is that we are moving to a much more fractured world, sadly, I would say, but that just seems to be true. And as investors, we need to reflect what's true rather than what we maybe would prefer to happen. So what seems to be true is the world is fracturing geopolitically. And as investors, that should mean less correlation in equities markets in particular. So in the calmer times, you could just be so-called risk on, right? You could sort of just buy the S&P, and that was a proxy for global risk, and that was sort of sufficient. Now, we think you, as investors, we're all going to have to be a lot more granular, a lot more kind of specific in exactly what risks we want in the portfolio. And that includes certain geographies outside of America. So I would highlight Japan as one. I'd highlight maybe India as another. But the broader point is, yes, we still like the US, but in a fractured world, we're going to need to be kind of more expansive and think beyond the US as to particular areas of the market, the global market, that we think can do relatively or even absolutely okay as part of this fractured, more fractured world.
Interesting. So you have to diversify risk, basically, and look at some of the other markets as well, like you're saying. Ben, on a side note, I mean, gold has been such a stellar show this year, right? I mean, if you look at the targets, I think most of the big Wall Street banks, they still have targets northwards of 3,500 USD. I saw one, I think it was Goldman Sachs, saying 4,000 plus. Do you think gold will still keep drawing in this kind of fund flow?
I think so, yes. I mean, look, gold has got a 6,000-year track record of being the diversifying asset, maybe all the time, but particularly in times of uncertainty. And heaven knows we've got one of those right now. So yes, it does feel like a time for gold. We'd only want to have a certain proportion of that in the portfolio. So, again, obviously at BlackRock, the world's largest asset manager, we would always sing the song of diversification. I think that's very important. But as part of that, gold continues to do well. And I think, again, over a very long period of time, the benefits of having some exposure to gold as part of a well-diversified portfolio, in particular during volatile moments, I think are well established, and we think that's going to continue. So yes, a lot of merit for gold in the broader portfolio.
And speaking of diversification, you mentioned the bond market, right, which I think finally forced the U.S. president's hand. That little drama that played out that finally perhaps made the U.S. administration back up a bit. Was that just a one-day event? We remember that surge, right? US 10-year suddenly was shooting up to 4.5%. Conspiracy theories about whether China is selling treasuries or Japan is selling treasuries. Do you expect more of that? Because that's where markets really get rattled.
We expect more of that, yes. I think we're in the midst of a global rate reset higher, driven by inflation, which, as Chair Powell was saying overnight, continues to be much too high already, and that's before the inflationary impacts of tariffs start to feed through. So we're likely to be moving into, indeed, at BlackRock, we would say we are already in a structurally high inflation environment. That has implications for the Fed. Simply put, they can't come in and save the day. And then to your question, that also has implications for longer-term interest rates, which we think should, over time, move higher. So you're exactly right. We had a particularly kind of exciting, dramatic moment last week, which for sure we need to focus on. But it's actually a bigger story than that for us at BlackRock. It's a part of a structural trend higher in interest rates, driven by higher inflation, which we think is going to continue, and actually is only going to be exacerbated by the tariff, the inflationary consequences of tariffs.
All right, Ben, I want to ask you, what do you make of Powell's statements overnight? He said that they've got a tougher job than they were earlier thought about. And did he put to rest any kind of Fed put? What was your reading of what he said overnight?
Yeah, I think so. Look, I thought he spoke truth, right? He said, look, inflation's a bit high. I'm going to paraphrase here, but he said, look, inflation's a bit high, and that's a constraint. So the Fed has a dual mandate. And I always want to be really clear. Mandate means mandatory. It means they don't have a choice. Their mandate is given to them by Congress, and they do not have an opt-out clause, right? It's mandatory, and the dual aspect: one, kind of employment growth; two, inflation. So Powell, I thought, was just reminding us of that, and therefore saying, look, the inflation side is already a bit high. Tariffs are inflationary. That's a non-political, non-controversial statement. That's just true. And therefore, the Fed is going to be somewhat constrained in how much it can come in and bail us out if there is a growth or market problem. So there is a Fed put, but the strike is probably a lot lower than we would all like. And we are not close, I think, to that Fed put. So Powell, I thought, spoke very well, very clearly, as he tends to do, reminding us about the binding nature of both sides of the mandate, and in particular inflation, which is just too high and potentially going higher as the ramifications of tariffs work through.
You're saying that you would not be surprised if U.S. rates head higher, inflation. How much higher, Ben? Do you have some sort of a range in mind, 10-year?
Yeah, so we think ultimately that it's reasonable to think over time that the 10-year can start with a 5 handle. That seems totally reasonable to us. And that is potentially a real kind of issue for a U.S. administration and a U.S. economy that's obviously got substantial amounts of debt. One kind of really interesting aspect of this, by the way, is like 30% of that debt is owned by foreigners. So it's quite an interesting aspect. President Trump seems to be moving towards, as he said many times, an America First policy approach. Sure, that's fine, but it's also true that 30% of your funding comes from foreigners. So I'm going to be very interested to see how the U.S. administration squares that circle of being, as they've said, America First, but I guess also being somewhat friendly for the overseas funding, which has been such an important part of U.S. growth and exceptionalism, I think, over the last many years and decades.
Well, indeed, Ben, it's going to be very, very interesting with regard to how he rolls over as well part of that debt at a higher interest rate. And as it is, they're running a big deficit number out there. So interesting times. We'll keep an eye out on the markets, but also I think the bond markets, they deserve special attention. Thanks a lot for joining in. Always appreciate your comments here on CNBC TV18. Well, time before we slip into that break, let's get Mitesh back in. Mitesh, welcome back. Well, that buy the dip is working out yet again. We were down 130 points. We have pulled back a little bit. And the Nifty Bank, that's rock solid, right? Just thumping ahead as we speak. Your view?
So, I think the bias and the directional structure remains on the positive side. And therefore, I think, you will see declines or profit booking pullbacks being bought into. I have chosen, in fact, IT stock, given the fact that IT was sector going through bad news, and yet I think there is OFSS, which is now trading near yesterday's close and near the day's high. So buy here the stop just below levels of 78.10, which is just below today's low as well. And we will look at targets of around 8100 to begin with, maybe more, but that's the first target. And SBI card is a buy as well, with the stop at about 875 for targets of 920.
Okay, got that, Mitesh. Mitesh, just on, some of the financials, because that clearly is the strongest part of the market. Apart from, say, an ICICI Bank, which is the index leader right now, anything else? I mean, what are the other broader trades that you would want to take in either banks or non-banks?
I think the banks is, of course, one of the safest sector, in the sense that the chart structure is one of the most positive over here. Though I think the only worry is that now the banks are reaching 53,800 level, which is where we had the highest weekly closing. It was 53,834 on the 27th of September. So maybe, when you reach a previous high, you will see some profit taking place. So around those levels, I would suggest taking some profits off the table. But otherwise, it remains a sector to be in. That apart, I think, stocks like Adani Group stocks are looking very positive to me. The insurance stocks like IDFC Life, LIC of India, and ICICI Pru also look very interesting in the short to medium term chart spaces.
Okay. All right, Mitesh, we'll leave it on that note. Thank you very much for joining in. I'll take a break right now. Come back on the other side. We'll get you the latest from the commodity markets.
Welcome back. Well, the big boy HDFC Bank has made a fresh 52-week high. I think that should come up for you on the screen. In December, it had gone all the way to around 1,880 rupees. And today it surpassed that, almost at 1,900 rupees. So HDFC Bank is now making a 52-week high, while the Nifty is still a good 10% away from that mark, 10 to around 11% or thereabouts. So the big boy has found its form yet again. But let's talk about a couple of earnings reactions. And Angel One, that's under pressure. Remember, the stock has pulled back a goodish bit from the recent peak, but Q4 numbers were disappointing. Upasana joins us to fill us in with a quick analysis. Upasana?
Well, the company has reported a weak set of numbers. It's a sequential miss across the board. Now, high operating expenses led to the decline in the margins and profitability, and company's cost-to-income ratio stood highest in Q4 this year at 71.6%. Now, in terms of gross client acquisition also, it saw a degrowth of as high as 22% and it slowed down sequentially as well. Now, 30% is what we saw versus in the last quarter. So, if we compare sequentially, it is a big degrowth. Now, total client base also saw an uptick of just about 5% sequentially, and market share also saw a dip in equity, F&O and commodities, while there has been an uptick of nearly about 10 basis points in companies' cash segment. Now, coming to the numbers, now revenue saw a downtick of 16%. This was mainly impacted due to 21% fall in the company's net broking income. Order volume, which is the key revenue driver, fell nearly about 23% sequentially, and EBITDA margins, as stated earlier, were under pressure, are down nearly about 680 basis points at 32.5%. PAT also saw a downtick of 38%, and company's average daily turnover also declined 19.7%. Now, company says that FY25 performance subsums regulatory changes and even softer market conditions. So, all in all, weak set of numbers from Angel One, and we can clearly see the stock price.
Okay, all right, got it. Upasan, thanks very much for that. Let's move back to IT now. IT obviously is taking it on the chin, the sector of the day for all the wrong reasons. Rima's back with us. Disappointment from Wipro and now nervousness about Infosys. Rima?
Indeed, and now the Nifty IT index is down 25% year to date, underperforming the Nifty itself by more than about 20%. That said, the IT index is still about 5% away from its 52-week low that it hit on 7th of April. For starters, Wipro is the top large cap loser after the Q1 guidance disappointed at minus 3.5 to minus 1.5. Then you had Sonata issuing a revenue warning for Q4, saying that the revenue that they were anticipating from the largest client will be lower than estimates. And some analysts are saying Sonata's Q4 revenues could actually decline in high single digits. As you said, there is nervousness now. What Infi will do? Will they guide or will they not? Given the uncertainty, will we see an FY26 guidance from Infosys? And if we don't, that means the uncertainty lingers on for the next 3 months. So far, if you remember, both TCS and Infi have missed the mark on the top line. Revenues for both the companies have fallen in the March quarter by 0.8% quarter on quarter. Both the managements have highlighted that there is cautiousness in the air. They are taking a wait and watch approach. Wipro said the clients are taking a measured approach when it comes to large transformational projects or discretionary spending. And there are some delays, some projects which are being put on pause, some decision-making delays. And finally, I'm just going to put up the IT calendar for you up on your screen. Today, it's Infi, Tata Elxsi, but over the course of the next 1 week, we'll have numbers from HCL Tech, LTI Mindtree, Cyan, LTTS, Emphasis, Persistent, Tech Mahindra. Basically, the entire picture will be clear, by the time next week ends. Back to you.
All right, Rima, thanks very much for that. So awaiting more IT numbers then. Let's now talk about the commodity markets. Let's see what's the headline with Manisha. Manisha, I was about to say happy Friday, but it's a happy Thursday. We're getting ready for the long weekend. What's the latest?
Well, ahead of the long weekend, especially, and it's not just for India, but most of the international markets as well. And we've seen some more buying come in for gold. Overnight, we've seen stronger gains in the Asian markets right now. We're trading at 33.57 of an all-time high yet again for gold. It's come off slightly, trading at 33.40 at this point in time. But in the overnight markets, we've seen 3% of gains come in for gold. And that's a report card of what we've done till now. On a weekly basis, we're up 4.5%, up 10% on month. And for this year now, we're up 27.5%. And if you look at the last 12 months in case of gold prices, it has given you a 41% of a return. Also, when you look at it on a year-on-year basis, as I said, for this year until now, we are up by 27%. Last year was 28% of gains. So even as we are into the 4th month of this year, it's almost an equal kind of gains that the gold prices gave you in the previous year as well. 2023 was 15% up. So the last couple of years clearly are doing very, very well for itself when it comes to gold. Well, gold has posted 25 all-time highs in 2025 till time, and it has posted 13 all-time highs above $3,000 an ounce. So clearly the distance that we've seen covered between 2,000 to 3,350 has been the fastest that you have seen gold ever do in the history there. Well, it has been about escalating US and China trade tensions that has been supportive. It also has to do with NVIDIA warning of all impairment in the first quarter sector, talking about $5.5 billion there because of the kind of tariffs and restrictions that are coming in trade, especially between the two countries, which is US and China. And then US also has ordered probe into possible tariffs on critical mineral imports. So this uncertainty, these concerns is what seems to be really getting in more safe haven money in case of gold there. The markets also are reacting to the US dollar index continues below 100, which is a 3-year lows for that currency there. And then there's a huge amount of ETF buying, which has been supportive. You know, between the months of August to November, perhaps, ETFs were redeeming. But if you look at the first quarter of 2025, the ETF inflow has been the highest in 3 years at around 226 tons. Now, this is what tells you on how the global ETF markets have seen tonnages in sense of gold there. So Jan, of course, started with 34.5 tons. But Feb and March have seen more than 90 tons per month go in. And the expectation is that month of April seems to be doing quite well as well. Well, the markets do believe that the momentum is still on the higher side. Gold prices can continue higher, except if you are looking at very strong central bank buying as well. In this year, until now, we've done 44 tons. And if you look at the previous few years, 1,000 tons per year is what the global central banks have bought. 2022 was a record 1,082, and since then we've continued to hold above these kind of levels till time there. The markets believe that, as I said, momentum is still on the higher side, and any profit taking as and when it comes would be only after we hear some positive cues coming in from US and China in sense of trade talk development. Until then, you could be looking at higher highs.
Okay, all right. Thank you very much for that, Manisha. So gold continuing to sparkle. Well, we'll take a break. On that note, come back on the other side, and it's our special segment. It's the economy. Lata today discusses details with Rikin Shah, who is the banking expert at IIFL. He talks about whether bank margins have bottomed out.
Welcome back. Bank Nifty has become the toast of the market after a fairly long, lean patch. In fact, today, ICICI Bank and HDFC Bank have posted 52-week highs. Both these banks, along with Axis, have hurled surprises at us by cutting their savings deposit rates after the Reserve Bank cut repo rate twice, while the state-owned banks, SBI and Bank of India, have expectedly announced term deposit cuts. So does this mean banking sector as a whole has seen the worst of its margins? Now, the other surprise, of course, we got this morning was IDFC attracting two marquee investors, Ardia and Warburg Pincus, into its fold. Warburg Pincus coming back yet again. So banks all over the place in terms of news, and two of them are announcing their numbers over the weekend. To give us an idea of what to expect from this sector, I have with me Rikin Shah, the banking expert from IIFL. Rikin is the Senior Vice President at IIFL. Thank you very much, Rikin. Well, first up, I wanted to ask you this. Bank margins, have they bottomed out with, 5 of them cutting either savings deposit or, FD rates?
Foremost, Lata, thank you for having me over. Regarding your question on the bank's margin, clearly we have seen the RBI cutting the repo rate by 50 basis points, and our house view is of another 50 basis points of rate cut in the upcoming policies, 25 in June, and subsequently one more 25 basis point of rate cut in this calendar year. Now we have known that usually a repo rate cut is a margin drag for the banking sector and a positive for NBFCs. But the banks, as you rightly pointed out, have responded to this repo rate cuts either via cutting the SAR rates, and it's not only the frontline private banks, but even multiple mid-sized banks which have been cutting SAR rates anywhere between 25 to 200 basis points in last 2 months. On the other hand, only HDFC Bank, Kotak, and a few other PSU banks have cut the term deposit rates. Net, the way we think about it is that a typical 25 basis point of repo rate cut drives 8-9 basis points of margin contraction in the first year, and subsequently, as the deposits reprice, that reverses. But what the banks have done is that with the SAR rates now getting cut, there is some cushion to this margin sensitivity that we are talking about. So this 7 to 10 basis point of margin contraction goes down to 5-6 basis points given the SAR rate cuts that have been done by the bank. And hence the drag on the bank's margins will be lower than what we would have estimated a few months ago. But net, just to summarize, I would say that 50 basis point of rate cut is built into the numbers and expectation. And with further 50 basis point of repo rate cuts on table, we'll see more margin pain in the coming quarters for the banks.
Okay. Well, just for the benefit of those who don't use abbreviations much, when Rikin says SAR rates, he means savings account rates, something which all of us have. But Rikin, there is a clear possibility that the rate cut cycle will go even further to probably 5 quarters, considering that we have got inflation rates coming below the MPC's mandated 4%. 3.3 for March and April. The poll I got was 3.1. You can't rule out, is what economists think. So how long does the margin pain go? Assuming that, you're not just going to get in June and August, but also in September. Or if there is a 50 bips in June, who is to say? Then the margin pain is what, only up to Q1, or does it go to all of FY26?
So, Lata, we think it's the entire part of FY26 where we'll see margins continue to slide lower for the banks, partly due to the rate cuts in the first half, and subsequently in the second half, even the MCLR linked loan book will see lower pricing because the lower deposit rates will translate into MCLR, and subsequently when the MCLR rates will start going down in the next few quarters. So FY26 margin pain is likely to stay. On the other hand, some other earnings driver like credit costs will start looking better from second half of FY26.
Oh, you expect credit costs to start lowering? For the PSU banks?
Stabilized.
Okay, it'll stabilize. I just wanted to ask you whether, there will be a distinction between private and public sector banks in terms of margins.
Yes. So private sector banks typically have around 50-55% of their loan book linked to EBLR, which is largely T-bills and the repo-linked loans. On the other hand, PSU banks have larger proportion of their loan book linked to MCLR. So in the first few quarters, we'll see the private banks margins getting impacted more because the repo-linked loans get reset almost immediately when the RBI cuts the rate. On the other hand, the MCLR-linked loans will take some time to kind of get repriced, and hence on a relative basis, PSU banks' margin contraction will be slower and a bit more back-ended vis-a-vis the private sector banks. But having said that, there are a few more nuances even within the private sector banks. Each private sector bank typically has a 1 month to 3 month reset even for repo. For some banks, it gets reset almost immediately. For other banks, it may get reset over a month or two. And hence, there can be inter-quarter movements wherein we may see margin contraction coming for a few banks first and then subsequently in the next quarter for the rest.
Okay, then let me just ask you about the results itself before I come with other questions. Which are likely to be the positive ones in the coming result season starting Saturday?
Sure. So foremost at the sector level, we are saying that the earnings are likely to be very sluggish for the sector as a whole. For the aggregate coverage of the sector, we are forecasting PAT to degrow 7% YOY and grow only 1% QOQ. It's a function of loan growth decelerating, margin contraction, and credit costs still remaining elevated for the sector. Now, within this, individually, we expect banks like ICICI, Bank of Baroda, and HDFC Bank to report better than consensus numbers. On the other hand, three names where we believe there could be misses to the consensus should be Federal Bank, RBL, and IndusInd Bank. The other banks should largely be in line with the consensus expectation, but the overall earnings growth trajectory, as I pointed out, is going to be very weak in this quarter.
Okay, well, actually, let me ask you a little more on IndusInd. Their ultimate number was not worse than the number they had prepared us for. They had prepared us for about 19-20 crores of financial accounting adjustment. It didn't turn out to be worse than that. Does it look attractive now?
Lata, we would refrain from talking on individual stocks, but all I'll say for IndusInd at the moment is that in addition to this accounting derivative loss, whether disclosures out there, the fundamentally as well, the loan growth is likely to remain under pressure and margins should see significant contraction, given that they have raised a lot of funds via high-cost certificate of deposits. And also because the slippages are going to be elevated, so there will be a lot of interest reversals and margin pain. In our published numbers, our FY26 ROE for the bank is only around 10%, which is meaningfully below its cost of equity. So it's going to be a slower fundamental improvement for the bank from where we are currently.
Oh, okay, that's a pity. Well, let me just tune out of results for a minute and then come back. This IDFC news is quite spectacular. Warburg sold off only in March of 2024, and they are now attracted back to the same bank. Will you include that in your coverage? Any opinion on IDFC itself? And is this a positive for the sector itself that, marquee funds are interested at current levels?
Again, without getting into a specific name in detail, many mid-sized banks, including IDFC First Bank, have seen significant correction given their exposure to the MFI sector. Okay. Now, as we stand today and looking at the bureau data, 4Q will see more residual pain for the sector given the slippages will be elevated from the loans which are already 30 to 90 DPD. But the early bucket trends, the collection efficiencies have started improving. And notwithstanding any big negative surprise starting from 1st April when the MFIN norms are getting further tightened and lenders can have lenders can have exposure to borrower only up to 3. We believe that MFI is at the fag end of the asset quality problem. In next 3 to 6 months, the slippages will start picking out and the credit cost may take another quarter or two depending on what kind of lender we are talking about to peak out. Having said that, while asset quality problem for MFI sector will start abating, growth is something which we are still cautious about for the sector. The industry as a whole may not see a significant growth in FY26, and that is where some risk to the MFI growth estimates for lenders are likely to be there. In context of given that asset quality pain is abating, I would imagine that many mid-sized banks who have sizable exposure, including IDFC First Bank, can start reporting relatively better operational trends from next quarter onwards.
Okay. Well, I'm going to ask you a head of research question, but I'm sure you will be in on this advice. Do you think Bank Nifty has, or banking stocks, have a chance of outperformance in the next few months? Because the chorus seems to be that domestic-focused stocks, especially in a country like India, which is largely domestically driven, are likely to do better, and it is the internationally focused stocks that are likely to do be a little more wobbly. So what's the IIFL opinion?
So our house view has been that in the last few months, we have already seen banking sector outperforming broader market. It's primarily a function of flight to safety because the valuations in other sector are relatively a lot more stretched, whereas banking sector valuations are inexpensive. So in that context, banking sector has been outperforming the broader market. But given that we are now talking about a longer and a bigger rate cut cycle, and the earnings growth for banking sector in the entire FY26 is at best going to be low single digit. I think the banking sector can take a breather in the near term. It's only in the second half of FY26 where we believe that as the asset quality starts stabilizing, a lot of margin pain gets behind us in terms of the numbers. And when we start looking at FY27, when the earnings growth is expected to be mid-teens, we expect the banking sector to start again doing relatively a lot more better than the other sectors. But in next few months, as the results kind of pour in, we would see that the earnings are going to be very tepid. There will be some more downgrades in the estimates. And hence, from that perspective, it's not one of the topmost or preferred sector for the IFL within the entire construct of all across the sectors.
So right now, NBFCs will be better than banking.
Yes, some high growth NBFCs would be better placed with vis-a-vis the banks.
Okay, we'll leave it at that and touch base with you after perhaps the weekend. The weekend will be a busy one for you and for us as well, with a bunch of banks coming in. I think ICICI, HDFC and Yes Bank as well coming in with results, and then there'll be more following. But for the moment, I think the Bank Nifty has a lot to cheer. It's not just the best performing index. Two of the index heavyweights, ICICI and HDFC, are at the moment at their 52-week highs. So a lot going in favor for the banking space. Among the other, of course, Eicher Motors and Bharti also at 52-week highs. So a lot of stocks have something to celebrate. Banks have a little more, perhaps. On that note, we wrap up on Bazaar. Chartbusters will come up after a short break.